Hey, what's up, loan officers? James Yancey here. In our private Facebook group, I've been sharing with you that we were going to retest these imbalances. So we're looking at a day chart here of the 30-year bond, the 10-year note, and the 5-year note. We always want to look at a triad of bond instruments to help us determine the direction of overall rates and therefore mortgage rates. So when we do that, I've shared with you we were going to come back to this imbalances, which we have. We actually, on the 30-year, have come beneath it, and we're now trading into this box here that ultimately is simply this last down close candle right here, this black candle right here. All I've done is outline that candle because that's an area of resistance after a big impulsive move up. And as you can see, the bodies of these candles here, none of them have closed beneath this or really inside this box. So that's what I'm looking at now. And I want this level to hold. I do believe that we will pull back into this, and we'll look at the news and see why. But if we look at the 10-year and the 5-year, we can see we're right at the imbalance. We're right at this low on all charts of September 6th, where I drew out this white line on all charts saying we did not want to close beneath it. And we only body closed beneath it on the 10-year note. Everything else has respected that level. So that's what you call being very accurate in regards to technical analysis, because we've respected these levels, and we've respected these levels throughout each time I've given you any analysis and updates. So ideally that continues, but right now we are seeing a lot of adversity with news. So ultimately, as price comes down, it's now consolidating or staying in a sideways range. Okay, so if I were to draw a box around any of these price levels, we can see that it's basically a square of price. You know, it looks almost like a barcode right here. That is very hard to read price action because anything can happen there. In other words, price could move up and it would be no surprise. Price could move down and it would be no surprise. Typically, I like to see a fake out. So if bond prices are to rise and get better, I want to see prices, at least in one of these charts, come down in order to go up. That would be what I would like to see. Ideally, it would happen on one of the shorter term instruments since the Federal Reserve controls the lower end. And ideally, we stay where we are on the 30-year, the higher longer term bond. That would create a divergence. We want to see divergences. I've explained to you divergences throughout my posts. And ideally, you have a better understanding. Inside of this new private group and inside this video format, ideally, those of you who raise your hand and have some questions or whatever, I'll be able to provide you guys some additional insights. But all that said, where we are in the market right now is going to be totally based on news drivers. And I don't want you guys within our group to be overly focused on fundamentals. Quite honestly, they don't really matter. They sound good to make things more complicated, but ultimately, as you've seen if you've been following my posts, all you really need to understand is the technicals. And the better that you understand how the charts move and where the movements should happen, the fundamentals ultimately support what the traders already know. So that said, today we had non-farm payroll, the employment change, and more jobs were created than expected. About 20,000 jobs were created in excess of what was expected, and that is not good for mortgage interest rates. Tomorrow we have unemployment claims. So right now forecasted, they're expecting 221,000 jobs to be, or new unemployment claims to be made. If it's higher than 221,000, that is good for rates. If it comes in less than 221,000 new unemployment claims, that's not good for rates. Okay, so in the previous number, okay, the third column is the previous number, it was 218,000 unemployment claims. So we're expecting them to go up. It's being forecasted that they increase. So based on what's been happening, it's probably unlikely. With what's happened with the hurricane and the weather that we've been having, that may lead to some increased unemployment claims, but most likely not in tomorrow's print. So that could be the driver to make interest rates worse, closing the week out. Friday, we have more news, the overall change in unemployment and the actual unemployment rate. So we want those numbers to be bad for the general public. That would be good for mortgage rates and ultimately good for mortgage clientele, whether it be refinances or home buyers. So we have a lot of news, and that's why we're seeing consolidation, because last week we had a break on news. As I mentioned, I will be taking a little pause in providing updates because there wasn't going to be much news, and that these imbalances here would be our protection. I also mentioned that I was looking to lock based on a bounce from that imbalance. So last week, let's call it the 26th, I believe was my last update, and you can see we got that bounce from the 26th through ultimately yesterday, and now we've pulled back on today's news. So ultimately, you're seeing exactly how the market trades. Uh, Unfortunately, as you can see, this market is day by day. If I'm going to look at a smaller time frame, like a 4 hour, uh, we can see these exact same levels, okay? But we can see that volatility now inside that imbalance that's here. And if we look at this chart, oh, my imbalance isn't transferring to that. Let me fix that really quickly. Give me 1 second and we'll be out of here for the day. I just want to show you this. Let's see, go add this to an hour chart. Oops, I hit cancel instead of okay, hour, okay, boom. So now we've got it on a 4 hour chart. Here's our imbalance zone. So if I zoom in to this imbalance on this chart, we can see how we've respected the midpoint in this line on a 4 hour level. So 4 hours, would be 8 candles in a day. So today, when that news came out this morning at 8 o'clock, which was bad for mortgage rates, we can see price came down. Okay. So if tomorrow's news is also less than ideal for mortgages, which is what I'm expecting, we ideally hold the bottom of this range. And on the 30 year, that means we would come into this range. So we'll still be within our imbalance, but pricing will be worse. So depending upon what you need to do for your client, if you're closing, next weekend, you've got to get a CD out tomorrow, you're going to be locking in a worsening environment. But if you know, can go, if you're 2-3 weeks out, you may want to float. We're really at a dicey scenario. I'm expecting rates to get worse before they get better, because we need a news driver that supports price. Ideally, we've got a lot of turmoil in the world right now with some war things. I've shared with you guys throughout these posts on Facebook and inside of our group that I was expecting black swan events. We're seeing them. We're seeing them with weather. We're seeing them with war. We're seeing them with things that could really create volatility in the market. And that's why we're seeing this uncertainty and this sideways action in price. So again, I do anticipate, rates over the next couple of days, just because I don't expect the unemployment print to be positive tomorrow, because it hasn't been. The trend for unemployment has not been increasing. Again, with the weather, it will most likely increase because obviously there's a lot of damage, but there will be different jobs created because obviously a lot of people will need to go into construction, people clearing the demo and debris and all those things. But so it may be, it's kind of hard to say exactly what will happen. I don't overly focus on news and fundamental basis things. I look at the chart, and right now the chart's telling me that it will probably come down a little bit before it gets better. So I'll see you in the next one. Invite your friends to this group who are loan officers. I'm only going to be keeping this open for this initial group for a limited time because you guys joined this new group a little bit early. I'm going to be trying to give you guys some additional education. So if I go back to print, you'll have a greater insight into what exactly is happening. So I'm also going to be creating some community tabs inside this new portal. So stay tuned, and I'll see you in the next one. Have a great rest of your day.